This is Randy Finney with Right Side of the Chart, and today is Wednesday, August 7th, 2024. It's 10:21 a.m. Eastern Time, and this is video attempt number 2. A couple folks pointed out there was no audio in the last video I sent out today, and that has just been an ongoing thing. Kills me because just randomly every so often, but not frequently enough for me to always check, this screen recording software just randomly and spuriously decides to disable the record audio option, and there's really no way to see it. And I just I do these videos and upload them, especially when they're time sensitive, try to get them out to you as quick as possible. So no big deal. I kind of summarized the kind of couple the most important things that I covered in that video, and I'll cover again here today in this one, and it should be a little quicker since this is the second go around. Is the kind of the modification of my trading plan on QQQ, and I got that out in a post to you as that video was uploading, so you already know. I closed it out here, shared my thoughts. I'm very open to the possibility these additional targets could be hit, and that's what I said in that post. T2 was the bounce targets I gave you yesterday. Remember, we went long Monday morning in pre-market before the lows. These are the regular session lows, so we gamed it up there, had that pullback as expected as the arrows were drawn. Before and after, while T1 was hit, next thrust up, but I kind of truncated the returns and closed it out right here at the highs so far today. We'll see if that holds in that post I get out to you, and I'm going to show you why. Among other things, actually something I just caught right here. I use the PPO as a trend indicator. The zero line, some folks will use that. That's kind of the default. When the PPO is above the zero line, the trend is bullish. And when below, it's bearish. I also have different levels that tend to delineate the trends. That's, again, the default right there. And it tends to work, for the most part. You're in a bullish uptrend when you're above it, right? You can see it on the chart above. And when you cross down below, you're in a downtrend, right? And then I also have these kind of, levels that do a better job of helping to define that trend right there at 0.49. Either way, we're well below it, so keep that in mind. But let me go over the rest of this. I'm starting out with the market, and the last one I started out with gold, but I still don't have a very strong conviction in gold right now, and silver, and I'll update that in this video. Let me try to recall what I told you in the video. The gist of what I was getting at is, so when we hit the other day, remember, we were intra-period. We were well below the 200-day moving averages in QQQ, but I talked about that at the time. I'm talking about Monday morning. This is a weekly chart, and suspected, it's more than common, almost to be expected, you'd overshoot the 200s, and I was expecting a reflexive bounce. Told you I've been doing this a very long time, and it would be extremely unusual to quote the game of Monopoly, to pass go to jail, go pass go, don't collect $200, go straight to jail. No, the market doesn't go from being super strong, bullish above the 200s, and then down through them like they're not even there. It'll undercut. Sometimes it undercuts for a few days, sometimes it's briefly, and then you get the buyers. Again, it's Pavlovian conditioning 101. The bell rings, the dogs salivate because Pavlov's been feeding them, and dip buyers, they buy the 200. It's just it's kind of a hard kind of fact on trading the markets, right? There are some exceptions to the rule, but remember, I trade in probabilities, not possibilities. So, hard stop there. Got my bounce. Could there be more? Possibly. Very possibly. Of course, possibly. Probably. Probably not, is why I closed out the trades. If high probabilities of more upside, sure, I'd still be long and strong. Started scaling back into shorts, even paused that video at the time to take some shorts in swing accounts, which I've done. So that's what I wanted to kind of say. That's what's changed today. I expected a bounce. I expected only a reflexive bounce, not new highs or anything like that. We've got that. Can it be more? Absolutely. I'm very open to that possibility, but I frame everything. Every trade I take, I analyze, and I view it through the lenses of a risk-reward perspective. And so being that, and what I covered in the video, this so far, this impulsive move reeks more of the start of something much bigger than a typical correction. Remember, we had a lot of corrections along the way over the last year. They were a little more orderly. Obviously, the selling is always more impulsive on a correction. You have these big red candles come in corrections, but that's all those were. They were corrections. They were corrections back to the primary uptrend line. What this one was, in addition to the bearish engulfings on the daily, we're looking at a weekly chart here, but on the daily we had the bearish engulfings at the high. We smashed through trend line after trend line, and most importantly, we took out the primary bull market uptrend line off the beginning around the end of December, early January 2023 lows, and that put us on a pretty major sell signal. So, to me, it's a matter of, are we going to go up a little more in back tests? Do we go to new highs? Yeah, that's possible. Is it probable? No. So therefore, if my overriding view is, this is the start of something much more, increases the odds my additional targets are going to be hit, I would rather be a little early in reversing than a little late, because as I often say, when you're trading a bull market or bull trend, you can have the worst market timing in the world. You could be buying all the highs instead of buying the lows on pullbacks, and you still make money. And there's a old saying, there's a lot of adages on Wall Street. One of them is, never confuse genius on your part with a bull market, because again, you get bailed out even if you have the worst timing over time, right? Because the trend is up. However, you could kind of say the same in a bear market, but it's I always say bear markets, because stocks tend to fall a lot faster than they rise. If you don't believe me, just go back 20, 30, 40 years as long as you can and look at the stock market, right? So that's just a known fact. Therefore, I always say, when you're short selling, there's tremendous amount of profits to be made, and you make more money in shorter order, bigger percentage gains than you do in a bull trend. But you have to be Johnny on the spot. Your timing has to be more precise. Most importantly, you can't be too late getting in. And again, we'll talk about that. Most traders, as evidenced by SQQQ and the short ETFs, they didn't want to short those bearish engulfings or the trend line breaks we had on the 60-minute charts and all the sell signals here. And again, I'm looking at a week right here. They didn't want to short here. They wanted to short here. And here, I'll show you. I showed you in that video. When you go to a daily chart of SQQQ, it had the biggest volume. I don't know if you can see it in the video. I have my volume bars muted, but this is the volume candle. Biggest ever in history. You can roll back. It's never had that big a volume day ever. And so what that tells me is a whole lot of folks, more than at any point in time, wanted to buy SQQ right here. And yeah, the volume will go up over time because it gets split adjusted and all that. But it's certainly the biggest volume that we've had in years. You can see that there on the volume bars. And so that's my point, is that they don't want to. You can see the volume at bottom troughed here. And remember, there's probably 24 different conditions that I've cited leading up to the top. And one of those was my low volume indicator on QQQ. I talked about that. Kind of going on a little bit of a tangent here, but we can go back to QQQ, and I had this low volume indicator that back here I was telling you was firing. This is the lowest level it dropped to. Back here, it kind of started to get low, and then it hit that extreme. Remember, I had that red extreme level, and we hit that recently in QQQ. And what that was saying is the market was going up on fumes. It was going up because there were no more short sellers, very few. That's evidenced by the drop-off in volume. Stocks go up, if there's more buyers than sellers. And so you had the sellers were just kind of vacant, and it was just drifting up on fumes. And, of course, that was one of many red flags. So that's one way to use volume. The other way is buying and selling climaxes. So with SQQ, that's a potential. It was at least a near-term buying climax. Now, do I think it's over? No. SQQ, I believe, whether today marked the end of the bear market or the bounce, or I could easily see this thing going for a few more weeks. Probably not months. I would measure the time in anywhere from right now, when I got that post out to you, to within the next few weeks max. Most likely now to the next few days, because there was not hard evidence. There was really very little evidence of a bottom. We had some stocks with divergences that I covered. And again, we could carry higher. Like I said, it's not a hard all in. I made that very clear. It's just time. The risk reward is no longer very favorable. So it's a whole picking up nickels in front of a steamroller. If there's a big steamroller about to roll over this market and take us down here, we've already with near impunity, given I was, covering, we had a couple of short shots there, but trade rate on NQs is probably north of 80% lately. Been slinging it on the short-term time frames too, even 5-minute charts. I'll get to some of those in a second for those of you that do that. But let me just show you big picture here. That is the former T1 first target level, 449.70 support. It was good support. And there's a 23.6% fib right around there. It was resistance here. We had a trading range. Fell below the trading range, rallied back up. Finally broke above that trading range, back tested, and that was it. And we hit that level and we parked there for a day. Then we took it out and we undercut the 200s briefly intraday, and we're back above them. So this is where, again, where the algos, where the dip buyers buy. And if the technicals were different, I would be saying this is a good level to position for the next leg up for long-term investors, trend traders to buy for the next run to new highs. The last time you bought the 200s right here in QQQ, there was another 46% upside. If you believe that to be the case, or even half of that, then you buy here and you put a stop below the recent lows and you let it run. And that's it. Just don't overthink it if your view is different from mine. But based on the technicals, there's a lot of evidence, a whole lot more, that this is a significant top. Back then we had divergence here on the positive divergence when we hit the 200 days. Now you don't, and so that's it. So let me keep it very simple. I'm getting maybe a little too long-winded. This is a nice rally. I think we've sheared most and possibly all the meat off the bone. That's it. Now, as I mentioned before, I could easily see we have the primary trend line. That's very, very much in the realm of possibilities, or even probabilities, if you will, to go and back test the primary trend line, then get rejected. You also have, if you can see it here, if I turn everything off, you have the key 50-day moving average. That's that yellow line right here. Traders tend to buy the 50 on pullbacks, but when you break below it, it's resistance, and they tend to short rallies back to it. But then when you're above it, again, successful back test there, another successful back test there, and then we gave it up. Once you gave it up, they rallied back, short, rejected. So that's also another potential target. So that is my uppermost likely bounce targets. Why aren't I going long, staying, my swing accounts long up to those points? Because is it worth it to try to get another 3% or so when all of a sudden we could just go on and again, this may be the end point for the rally, and then we have a sudden and swift reversal, and then I'm at the position of saying, okay, now do I want to, if we have a hard down day, volatility is high, we could spike up, they spike down and gap down and have to chase an entry. I don't like, if we start reversing, we reverse suddenly and sharp, we come down here, well, and then we're coming up on my next target, and if anything, it's a place to go long, not to be shorting unless that gets taken out. So I don't know, it's just my trading style. I'd rather get in front, and look, again, it's not a hard all-in short, it's just a, you know what? Booked some nice profits in the last few days. The charts have been very conducive to active trading. I'm going to get to that in a second. And then at the end of the day, the bigger picture tells me there's a lot more downside. And so is it worth it to risk, a sudden reversal to try to game another 3% if you believe the market's going to drop another 40 or so from where we're at? And in my opinion, no. Okay, and that's it. We start taking this, this trend line back. We take this 473.50 level back. That's resistance. Things, could start to change, and then I'll talk on that. Remember, there's going to be a tremendous shot of epi, which is adrenaline, for epinephrine, into the markets via hopium of the rate cut that's now baked in the cake. Remember, we went from Powell kind of humming and hawing, oh, we haven't made any decision for the September meeting, to the street pricing in a very high probability of now not just a quarter point, but a 50 basis point cut with other additional cuts to follow. That went from 0 to 60 overnight. And that's the narrative they're going to be pumping down the throats of Main Street. Wall Street will be pumping that down Main Street. Buy, this is a rate cut. Oh, yeah, maybe we'll see a little hiccup in the economy, but it's a great buying opportunity, blah, blah, blah. All the reasons we bought, pre-market before down here somewhere. Were we all the way down to T3? Yeah, it might have been. Or we also hit the fifth target on the futures. All right, guys, so that's it. I don't want to... You do what you want, but that's where I think there's a good chance that... Again, if you want to least trail up stops, I mean, this was a beautiful opportunity to game that reversal I kind of arrowed out there for you yesterday. And if you believe we're going to go up there, which we very well may, just trail your stops or just set a relatively tight stop to protect profits. And then, or if you're playing the long game right now, this would be a scale-in zone because this is... anywhere from the downtrend line, the 50-day moving averages I just showed you on the daily chart. This is a 60 resistance here. This is your kind of scale-in zone where I think it's objective to continue to add to shorts, but and increase that. However, you may not get there. So that's, you got to have a plan A and a plan B. SPY, remember yesterday when QQQ had hit that T1, I posted right in that post that hey, I could see about another additional half point carry, half percentage point, because SPY had a little bit more to go to get to comparable resistance. Yeah, there's the gap. There's that big old gap from Monday right there, and the top of the gap's technically up here. So there's SPY. Daily chart, remember SPY hasn't yet visited the 200-day moving averages, and I don't think I can tell you with a pretty good degree of confidence we're not going much higher until at least it does. So that would tell me even if guys we're going to rally off the 200s and take out and make new highs, maybe go to the top of the final top market top ranges, marginal new high. That's certainly in the realm of possibilities if they really get giddy about the rate cuts coming up. It'll be a near-term rally. Remember we came within almost all the way to the top of QQQ, within 1.5%. SPY hit about halfway between my final market top range. Now, where I'm going is we'd probably want to come in. S&P would want to also check the 200-day moving averages. And so that's what I'm seeing, guys. I think this is, we gained with near impunity a reflexive bounce that I think is either over or very close to being over. That's my take as of today, and if it changes, I'll let you know. With volatility being high, active traders can make a lot of money if you're good at active trading and you're in and out quickly. This is a 15-minute chart of ES. I've been trading off the 15 and the 5. I've had for every trade you see on the front page, I probably have 10 more. And just 5-minute charts, in out. I'll show you. And one of them is this 15-minute chart. This is where we really started slide. Remember, we had a big move down into Monday's lows right there, and that's where I got the post out to you. Cover swing shorts, go for the bounce, likely bounce. And so when you look at Fibonacci retracements, which I've done here, you want to look at a major pivot point right there. That's where the slide started. So I put up the fibs. So in other words, if we go all the way here, that green line, that's 100% retracement. The typical retracement points are, the typicals are 38.2, 50, and 61.8. And that's the blue line here, the orange line here, and the blue line here, right? Yep. This was, today, when I got that post out to you and I was doing the other video, we had just hit, and I'm extending my divergence line out here for you. We had just hit to the button the 50% Fibonacci retracement. As I've said recently, technical analysis, at least my style, shines in volatile markets when the VIX starts to explode. that's fundamentals are out the door because they're changing so fast. You know, the bobbleheads on Wall Street, fund managers, and portfolio managers, they don't know left from right now because employment was great. Now, all of a sudden, what happened? There's a number out of nowhere. No, so and you know, these economic indicators are starting to become erratic, and obviously the trend is going one way. The trend is the economy is rolling over, and as I talked about, until recently they were cheering that as good because it was going to give us a rate cut. Now all of a sudden, the same narrative I said would play out is all of a sudden, be careful what you wish for. One day it wouldn't be good, and they realize, oh shoot, we're hoping for soft economic data, so the Fed will give us a rate cut, but we didn't realize, and that means we're going to see a recession or the odds for recession, and then earnings are going to go down. God, silly how Wall Street works, isn't it? So anyways, technicals. What I can tell you definitively, we hit to the button. That was when I was doing the other video, 50% Fibonacci retracement. We have negative divergence. Oh, and it's price resistance too. You can see the level was 53.6125, and it was almost exactly where we hit today when I was doing that other video. You even have a little minor trend line here. We probably picked that up on the 5-minute chart here. I'm drawing it for you here. So this little minor trend line break, and then of course you have the wedge. You have to do it like this. There's your wedge. Boom, that should take us down there. And that could mark the end. I'm very open to the possibility this may be the end of the run. If it's not, let me tell you something, guys. This is even better resistance. That's where I would be adding additional swing short positions if and when we get that high. It would be a better, you know, from a price perspective, you know, when you're shorting, it's being a bull or going long in reverse. The higher price you can short at, it's like, you know, it's like buying a long position. You want to buy as low as possible. So that would be an ideal and pretty aggressive short entry point for me. However, we may never get there. And based on everything that I covered in this video, and I'm going to continue to cover the reasons why that may be it. It's almost, you know what, it's too easy. It's too easy, and that's why I don't like it. We may get there, and I'll be shorting, adding shorts if we get there, or if I've already, you know, covered shorts that I'm in now, and I'm long up to that run, I'll be selling those. But it's just too obvious, and the market doesn't make it that easy for the masses. It would almost be too easy, and that's why it's like bait, if you will. And that's one reason I kind of pivoted today and closed out those. That probably would have coincided with that next bounce target I gave you on QQQ. And guys, hey, sometimes the technicals play out. Sometimes I overthink these things, and we could do that. And like I said, just, you know, protect raise stops or protect profits, and you're good. You're golden if you bought the other day. You know, that's the S&P. Let me go to NQ. NQ, that's the 5. I've been swinging this. Oh my gosh, this has just been so profitable for active trading. We had a little wedge here the other night with a breakdown. You can see I had a measured target down here, which we hit and then reversed, and we had positive bullish divergence, swung it up. So this is what I've been swing trading on. See these little trend lines here on the 5-minute chart. And now this is that resistance level we're at right now. There's that gap I was talking about the other day right there in the futures. You usually don't get gaps, but that was a Sunday night gap down. Pretty good size gap and crap. And there's those lows we bought Monday morning. And when T5 was hit, my target on the NQ daily chart. And now you can see this trend line here. You can see resistance. You see a big wedge. You see negative divergence. Here, I'll draw it in for you. I see it. And that's it. That looks pretty nice. So we break that. That's why I'm short. I'm sorry the audio didn't record on the other video, but that's why I made a point to get that post out to you, which is even, you know, quicker. I know some of you don't have time to watch these videos. So that's the 5-minute chart, the realm of the very active trader. Again, tons of money to be made if you're, you know, nimble and active and, you know, can just swing off these. And this is just that kind of abatement in volatility with the VIX coming down. But soon it should most likely expand. I'll get to the VIX in a second. Somebody asked me about that. I did cover it in that video earlier today. Here's the NQ 15-minute chart. So I also put up fibs measured from the peak there, that high right there, to the big drop to the low. And you can see, again, that's why I got that video. Well, that's why I'm redoing this video. Perfect 50% Fibonacci retracement. You can see that orange line. These are your fibs right here. If it pushes higher, there's your 61.8, very common retracement point. Again, objective shorting up if we get there, but this may be it. That is what I just drew for you here. I know there's a lot of lines on this 15-minute, but this is your divergence line. This is your uptrend line, just like on S&P 500 futures I just showed you. And that's a bearish rising wedge pattern. Break that. We could get the party started. At least back here, 17,996. Call that 18,000 right there. Well, they'll probably buy it there. So if you're active trading, do that and get back in. Or like I said, you need to find your trading style, your trading plan. If you're not an active trader, I know most here aren't. I get that, and I try to speak to the swing and trend trader often. There's a potential trend line. We get there, and we're at the 76.4 fib. You're at downtrend line. You can't see it, but it goes to the left off the highs. And so that's my max potential bounce target zone. I'm very open to that. I will use that to scale into shorts up to and probably not above that level. But again, I don't think we'll get there. It's too easy. I think a lot of eyes are looking for that. And I've traded enough markets to kind of go on instinct to where it's these bear market rallies or rallies and big corrections. Just when they start to look good and feel good for the bulls to get back in, get your toes back in the water, buy your Apple, Nvidia, that's when they rug pull and next leg down. So hopefully you guys find these videos useful. Hopefully it plays out. If it doesn't, look, it's like any other trade. Use stops, manage your positions. Let's talk the VIX. Let me refresh this one. Okay, so somebody asked about the VIX. The VIX has been, I told you, very tradable vehicle. The VIX long, then shorted the VIX. The VIX will crater during big rallies or even any rallies when it gets real high from nosebleed levels. So it's been a drop of, that was a 40% drop after a rally of whatever it was, but let me just get there. What I can tell you today, see this little level here, I've been trading off this, covering shorts on it. You have all this little area of consolidation there, and there's your support level now. We've hit it a couple times again today, 2178, and you can see just like the VIX will usually be the stock market in reverse. The VIX, they do have a VIX for the NASDAQ VXN, but this is VIX, tracks the S&P. It's more liquid, obviously. If you trade the NASDAQ, you could trade the NASDAQ VIX, but I like, since I'm a futures trader, I have more liquidity in VIX, so I'll use that. And it's S&P goes up and down with the NASDAQ. It just goes up and down less in percentage terms, but the VIX, you got enough juice in there. You don't even need the NASDAQ volatility index. This one works well enough. So there's a little wedge right there, just like I just drew on the 15-minute charts, I think, of SPY, with a even bigger downtrend line. So this was during that video when I paused it towards the end, when I did without sound today, I loaded up, or re-entered, I should say, long on VIX futures, short on the markets, both in active trading and swing accounts, starting to scale back in. And then if you remember, we had VIXY for you non-futures traders on Friday, because it was Friday, hit. I said, look, I'm going to close out these targets. It was a 50% gain. We were long here, hit T4 to the button, gave you an opportunity to exit. Some of you might have held out for the prize. If you went home short that weekend, you woke up on Monday with a almost perfect tag. You can see how these targets have worked out so well. T1 was hit here, T2 was hit there, with a perfect reversal. I talked about at the time. That's when we gained that first bounce. Remember when we just pulled back here? That's when we gained the bounce right here in QQQ off these other targets, that first target. So this market is just a active trader's dream lately. These levels are working very well. And then we had the futures meltdown over the weekend when they opened on Sunday. And boom, we hit that T5 right when I put the hard long, closing out all swing shorts. And so that is an obvious, hey, short the VIX too, because if the S&P is going to drop, rally in the NASDAQ 100 and drop, it did. That was about a 32% drop. But now, where am I going? Look where we're at. We're back to, and remember, this ETF on all these VIX ETFs and ETNs, they do an okay but not a perfect job of tracking the VIX futures or the VIX spot VIX. So basically, for all intents and purposes, we're back at support. Now, look, if we go up and hit those a little higher upside targets on the equity markets I'm talking about, and it happens soon, well, you're probably going to come back to this trend line. This would be, if we don't bounce here on the VIX, reverse, then a move down here to T2 and the uptrend line, give or take. Now, you'd want to line that with VIX futures and the spot VIX too. Here's a spot VIX. Remember, I've been harping on this one. Here where this was a beautiful major support zone, big positive divergence. This was so priced into the stock market, just like the equity charts were the indexes themselves. And there's that kind of explosive move up in the VIX. And is it going to be a 1 day or 1 week wonder? It's possible, but when you look at the long-term charts, let me do that for you real quick and do a comprehensive view of the VIX. So this is, and I'll try to get back to the other stuff here in a minute. This is where back in the past, in the 90s and early aughts, this is where what I called my previous bear market end zone. This is the dot-com bubble started there and it ended here, and then you started a new bull market and the VIX fell. But in modern times, modern decades, since the early aughts, this is where, and I put just before end of bear markets, because one thing I've told you before about the VIX, traded it well, is I tend to close my VIX longs out shortly before I close my index longs out, because it's been my experience that first the VIX peaks, then the stock market bottoms right after. And so, but essentially, you can see this is where bear markets end. And since 2009 to 2020, or up to now, this is where just bull market correction. So we were in an ongoing, I view, COVID, even though technically it was a bear market in 20 with 6-week drop, 36% in the S&P. It was what I call Ursa interrupted. It's a bear market that was interrupted by the Fed and DC with excessive stimulus. 2022, I'm still viewing that drop is just a first wave down, and just really a correction, because you can see this is where up until then the only last real bear market we had was 07 to 09, and that's where it ended. And then if you want to call, because COVID, you can call it a bear market, with 36% drop. That's where it ended right there, the spike. We haven't gotten there yet, so we just hit this level here. And I just want to point that out. And that's also, this is what happened in 2022. Look where the VIX, it didn't even hit bull market correction levels. There was no fear back then. And that's why this is just a continuation. It's been just one big excessive bubble that's been blown. I just wanted to point that out from a longer term perspective. We start getting up here on the VIX, and we start hitting some of my deeper targets on the NASDAQ and S&P 500. And then that's maybe time to cover those shorts and in position for a multi-month bounce measured well into the double digits. Okay, I think I've made my thoughts and outlook on the market pretty clear. As I often say, the charts are dynamic, meaning they're constantly changing, and so is my analysis. So if anything changes, I'll let you know, but that's it. I think I believe that we've sheared most of the meat off this bone. We may, only time will tell if we left a little meat on, or if I'm just dead wrong and this market's going to new highs, and then it's a whole different thing, but I don't think so. And so that's that. This is the VIX. No, I'm sorry, natural gas I wanted to cover. Remember, for active traders, we hit that first target. I gave you a 60-minute chart, which we're looking at here. And I gave you a 2-hour chart for more typical swing traders, a little simple with just 3 targets, and we're still beautiful breakout. Textbook, one of my favorite positions right now, especially on the long side. And although it wasn't mentioned in yesterday's post, we're also at long-term support. I don't have that chart queued up. I can do that for you. Hold on. Okay, here it is. This is Nat Gas Continuous Contract Futures. This is a long-term weekly chart. $2 right there. Remember I mentioned it here, $2. We had a reaction there. $2. It's a key level, and that's where we're at. We just pulled back to natural gas. Remember, I've been, this has been a very concerned. I've been longer term bullish. We got in at that low there. We came that. We got out. We've been using, natural gas as active trading, batting maybe not 1,000, but close to it on that lately. You got to just be patient. I call it the widowmaker if you're on the wrong side of this trade, because nat gas, she's either full throttle up or full throttle down. There are periods of consolidation, but when she wants to run, she runs. And you look for these divergent highs, divergent lows. Remember, we're coming off that divergent low there. We've milked that. We pulled back to that $2 level. So I just wanted to mention that where I've given you, I was very clear yesterday on what, at least in the near term, the target I'm looking for. And then longer term, look at the history of natural gas. Look at these moves. I don't have this one. Yeah, I do have it measured. I'll read them to you. From this divergent low right here, 563% rally from low to high. From this one here, this divergent low, 207%, 234%, 158, 222. So, I've always come up with a lot of stuff in trading. One of those is know your security. Call it the know your security rule. Know what you're trading. Know the nature of that security. And so, based on what I just showed you, look, we already had on that last run off the low, 110% rally in it. But based on these previous divergent lows at support, especially long-term, low end of the range, they're all, almost all of them are 200% or more. The smallest right there is 158% right there off this same level. Off the 2.5% support. Natural gas was notching down, but in recent years, this has been the bottom about right here. That 150 level. But this was also good support. So I just want to tell you that, because then that lets you frame it, like I am, if you will, that, hey, there's a potential for a whole lot more here than just, from the breakout, measure it. I already told you what it would be, I think, yesterday. If T3's hit about a 21% gain. So there's a potential for a whole lot more way up here, and I'll most likely be adding additional targets if and when this thing gets going. Just want to point that out. Or it craps out again, and I'll talk to, somebody mentioned wheat, and I covered those in another video. Yeah, wheat keeps showing us these little, on the 60-minute chart, it keeps having these little fits and starts, divergent lows, but we rally. We've had a lot of swing trades. I put out some longer term targets, which I still very much maintain. These T3, 4, or 5. This really, you can view it as one trade. Now, I'm an active trader. I've been in and out. I go off these 60-minute charts and shorter term charts. I use the futures. And we had these targets here, backed off that divergent low, T1, 2, 3 hit, reverse. And that came with a divergent high. There was negative divergence when we peaked right there. And that was a catalyst for that drop. And then we dropped and we came here. I pointed out divergent low, we broke out. And this is still just a bigger divergent low. So these are near-term targets, 1 through 4. I gave those to you a couple weeks back when I create that, July 30th, a week or two ago. And then these are longer-term targets. And again, maybe you were in here off that pull back to support or that breakout back test. And we only went a couple percentage points below that point. And so from a risk reward perspective, if you're a long-term trader, it's a 60% upside target to my 5th target. And we dropped a total of about 3.5% below that recent low. So it would have not violated even a risk reward ratio, stop based on even a very unfavorable RR. Meaning if you're shooting for 60%, you give yourself a 3-to-1 RR, that's a 20% stop loss you could allow. So, I think that'd probably be a little aggressive. You wouldn't need 20% in this one. You do a 10%, 5%, and you're still in that. Or it's a separate trade if you're actively trading. So right now it looks good, I just wanted to say. And, it keeps getting sold into, but it's a way to diversify. And the other ags that move along with it, the other grains or corn, still has that divergent low on the 60-minute chart. Still has these longer term potential targets. Look at this beautiful little wedge here. And just like, a lot like the stock market. If you've been on the site for a while, we've had a lot of those little 60-minute sell signals for the last year now, where each one, I said, had the potential to mark the end of the bear market rally. And they were all good for at least, for the first targets, short pullback trades, but the market, they kept buying it up and it went to new highs. And I call those, I refer to those as those seemingly innocuous little 60-minute wedge breaks, trendline breaks, that one of those we're going to play out to be the one that sticks. So far, now it's way too early to tell, but so far, when you go back here, this is a 60-minute chart on the NASDAQ. This one is the one that's stuck, and it proved to be, because what happens is when I say seemingly innocuous, 60-minute chart, long-term traders, that's hogwash. It's going to lead to a little pullback. It doesn't mean much. It'll be a dip buying opportunity. And a lot of these previous ones were just good dip buying opportunities, that one. However, this is the one that's stuck because the charts are stacked. They weren't stacked earlier in the year. What do I mean by that? I make a lot of terms up. Stacked means when I go out and I have divergences like I did recently, all the way from the 60-minute chart out to the daily, this was a divergent high, and out to the weekly, this was a divergent high right here. This one on the weekly, my DH isn't written there, but it was. You can clearly see the divergence. And unusual out to the monthly. This is like big time trend change stuff. When you get these monthly divergences, you don't get them often. And so that's what I mean by the chart stack. So up until we made a new high, I couldn't make the case for such a major top until we took out the previous high, because then that gave us, there was no divergence at this point here on the daily, on this weekly chart, on the monthly charts, but there was once we took it out. So everything here, and that's why when I say these seemingly little innocuous 60-minute divergences, that's the spark or the catalyst or the tinder, if you will, that then led to the, the breakdown and the sell signals we got on the daily and of course on the weekly recently. And now all I have to do is wait for some of my weekly trend indicators to flip to bearish, and especially the monthly trend indicators, such as the when you turn off all the lines, this level here, the 20-month exponential moving average, just does a bang-up job, phenomenal job of defining bull and bear market trends. You buy pullbacks to the 20. As long as you close the monthly candles on or above the 20-month, you're in a bull trend. When you're below it, like you were here, you're in a bear trend, just like in 2008. So that's why, from this perspective, those were the only bear trends that we had in decades. And so, we're still there, well above it right now. I'm just pointing out that once these flip, that's going to further increase the odds that my longer-term deeper targets get hit. As of now, I'm focused back on these 60-minute charts, trying to milk out, which I think might have done every bit of this little counter trend bounce, just like we did the last one. And we'll see. Okay, guys, I just wanted to reference that last one I did. What did I cover? I got the stock indexes. I don't want to beat a dead horse there. I covered that ad nauseum. My plan, where I think we might go. Gold and silver. That's it. And the rest I already covered. Guys, again, I've said it, but people ask, and I don't mind to ask. That's what you do. You're paying me for my analysis. I don't have a strong opinion on gold, but overall, I've been talking, kind of carrying a, not in positioning, because I don't have strong convictions yet, but more of a bearish outlook. It was a super bullish breakout to new highs there, but I think we may come back and test those highs. But what I can tell you and have been telling you, we've been in a trading range. Gold's been slogging around sideways. So gold bugs have gone nowhere for months now, but we've batted near 1,000 on trading it. So I've given you trade and ops, shorting these divergent highs, covering the divergent lows, and going long. All the trades aren't listed on here, but a lot of these are divergent high. We shorted. T1 hit, T2 hit, T3, T4, right to the button. We reversed, went long. I gave you 3 targets. We hit all 3. Then a recent mention is a short here. And now I just don't have a case. I can't make a case to be long or short. It's kind of slogging around, and I don't have any clear visibility on where the near-term direction is. You might think, okay, Randy, well, the market's seen a lot of volatility. Shouldn't gold be a beneficiary? Typically, yes, but not always. One of the problems with gold is it's been highly correlated to the stock market. Remember, the stock market just coming off all-time highs, multi-year highs, all-time highs. Same with gold. And so it tells me it's the same folks that have been buying the heck out of QQQ and NVIDIA and semiconductor stocks and Bitcoin and all these risk on assets. We're also buying gold. And one of the conditions of a market top, if I'm right, and this is we're at or already put in a major market top or very near to it, is it's just history just shows you time and time again. The FINRA used to be NYSE, now FINRA margin debt. I'm sorry, it's a debt, folks. Traders like me and many of you that have a margin account where you put 100,000 in your brokerage account. Your broker will let you buy up to 400,000 of stock, or even higher. You can leverage higher in futures. That's a margin account. You're pledging your assets, your account, and whatever's in there is collateral, and they'll let you juice it up. And what tends to happen, and it's just happened every point in time. I don't have that chart queued in front of me. I've shared it with you recently in the past. That as stocks go up and up and up, and all of a sudden people believe that this stock market in NVIDIA, it's a 20 to 100% of your savings account. Why, hey, I made, X amount, my NVIDIA doubled last year, or my QQQ was up 50% or 30, whatever it was. Why, I've got, 100,000 in it. Why don't I just, borrow on margin and leverage that up to 400,000 and, instead of, leaving money in the bank at 3%. And so again, it's time over time shows you that when you reach these peaks, margin debt is at extremes, and then the bubble bursts, and it's a vicious cycle. So where I'm going, gold and everything else, and Bitcoin, I mentioned right when I got bullish the other day on the market, covered shorts, I said Bitcoin would rally. It would be a risk on with the market, and it did, and it goes the other way. So the same folks, again, they're buying gold, Bitcoin, NVIDIA. It's all kind of intertwined. Their Schwab account, their E-Trade, whatever it is, or these online brokerages especially, that goes the other way. It was the buying on margin that exacerbated the move up. And likewise, when the bubble pops and the trend reverses, it has a powerful effect. And that's why I'm able to come up with these aggressive targets that a lot of people think I'm crazy calling for a 50% plus drop in the stock market in NVIDIA and even big, solid, great companies like Apple and Alphabet and Microsoft. It's not that they have crappy fundamentals. Their earnings will suffer in a recession or market downtrend, but it's the unwinding of that margin bubble. And so the way it works is you load it up on NVIDIA, and market starts going down. Your NVIDIA is dropping 20 and then 30 and then 40% off the highs. And so all of a sudden your broker issues a margin call. And they say, you got to come up with $5,000, $10,000 by the end of the day. Wire the money in or sell something to cover that deficit. If you don't, we'll sell it for you. And that's what happens. By 4 p.m., margin call is not met. They blow out whatever it is you have in your account. And if you're loaded up on NVIDIA, that's what they're selling. That's what they are. These folks are loaded up on Bitcoin, NVIDIA, QQQ, Apple, and that's how that works. Okay, so it's the same thing that made everything go up, and it was fewer and fewer stocks. Money was being crammed into anything with the word AI on it, and that went up, and then that just goes the other way in reverse. So, all right, I don't want to get ahead of myself, but I just wanted to kind of reiterate, we had some powerful sell signals all the way out here, and this is a weekly chart. We hit the 200s. They came in and bought it as they always do. Maybe they're going to buy it more, and maybe it goes on for weeks. I don't know. I just know that the risk reward now starts to diminish quickly from here on every tick higher. So that's it. And I covered gold. I didn't cover silver. Silver looked a little better on the chart. 60-minute chart to me recently. It still does now. Positive divergence, but as I showed you, I don't have a strong convictions on gold. I mean, silver's been just very tradable. Divergent high, divergent low, rally, T1, T2 hit, divergent get out. That was the final target. But then it broke this trend line. It was positive divergence, but and of the two, the chart looks better. Maybe it bounces, but I can't make a strong case to buy gold. And even though silver is my preferred trading proxy, silver or GDX, because they just move up a multiple of gold. Gold goes up X, silver and GDX tend to go up X times a factor of 2 or whatever it is. However, you want to make sure for me, I need to make sure I can make a strong case to be long or short gold, to be long or short silver, and I can't do that now. So feel free to bump me again. I just don't have strong convictions. Best looking trade on the long side right now in the commodities arena is natural gas, assuming that breakout sticks. If it fails, it fails, and don't be married to it. VIX has a potential to really run up here if we can get some downside. So basically, if you want to know what to watch or what I'm watching, it's those, you really have to go down to those 15-minute charts and 5-minute there. That's what I showed you. So there it is. So as I've done the video, we broke that first minor trend line. Now we're at the second one. They're coming in buying here, as they will on the first tag. If I wasn't busy doing these videos, I would have just reversed my active trades right there when we hit that support level. Let's see if we hit it on NQ. We hit price support on NQ. And that's what I do. This site, you guys are first and foremost. I get everything out to you guys. If I see something, then I'll do these videos and I'll trade when I can in between. So, but although Nasdaq looks like it may be NQ, can we cracking below there? Let me tighten that line up a bit. Sometimes these lines are a little finicky and hard to grab. There we go. Pull that. I need to pull that end down. Having a really hard time with this trend line here. There, I got a better fit. Yeah, that one's taken out. Boom. Right there. So just need to take out, well, whatever. We'll see. They're going to buy it because the ES is on the same level now. But so if ES, I'll wrap the video up here and get it out to you guys. That's what you want to see. Basically, a break of today's low should open the door to more downside. Certainly can't rule out, like I said, a little more upside. But I already talked about the RR and all that. And again, active trading is still very, very conducive if that's your thing. Let the 5-minute charts be your guide. As long as volatility is high, these little seemingly small swings, they're 1, 2, sometimes 3%. All right, guys, I got to wrap this video up here. Talking. But anyways, it's a lot to watch in the charts right now. And I'm going to give you I'll do at least one more update today, whether it's screenshots, static charts, or another video, and let you know if I've changed my thoughts. But as of now, I think it's an ideal time to start scaling back into those swing short positions based on the risk reward and the current technicals. This has been Randy Finney with Right Side of the Chart. Have a great day.